Hello and good morning to Behind the Markets on Money FM 93.7 and here live on Facebook. We're streaming live on Facebook, LinkedIn, and YouTube and Twitter. Thank you to everybody who will be joining us and those who will be catching the post stream. Thank you very much. And this is the week starting 16th January 2023, the third week for investors and entrepreneurs to build their momentum to get to the next stage. Remember that our purpose at Money FM is to improve decision making and also to improve the plight of the entrepreneur. We will be we will be joined obviously by Vernon later on. Should we be joined? Obviously, signals are always a bit sketchy sometimes. That's life. But I'm your host Munyumba Mutwale, and I'll be taking you through markets themselves. I'll be taking you through the latest roundups of the markets. I'll be taking you through the data from the forex markets to the bond markets. To commodity markets and what that means for the rest of the world and the information that is coming out of those markets and what to actually expect coming in today. Following that, I'll be actually taking you through some news of what's been going on domestically, some trips to do with the energy sector, multiple sections actually to do with the energy sector because that's been the hottest news. And one piece of data I'll be sharing also on probably the best solution, following up on Friday's trends that we were talking about. And finally, I'm going to end today with our Mindset Monday conversation on how to develop your push and pull forces, because what we're trying to do is become better investors by developing our push and pull forces. And what I said is we will be joined by Vernon anytime soon. I think he's actually coming in just
Live,
now.
on our platform. Hi, good morning, Nyumba.
Good morning, Vernon. I was screening our online audience today as we're doing our transition. That, to the people out there, was actually the joining of Radio Mix. So good morning to our radio audience. And yes, I am Munyumba Mutwale, and I'm about to go live. And we're live also on social media. So thank you very much, Vernon. Hope you've had a good weekend. And it is time to get started. So let's dig into the information that we have on the market data itself. For those of you who are trying to get back in, the FX market is showing that the Kwacha has lost value for 70 days straight. This is the second longest streak. Again, I stress this. This is the second longest streak since the record was set of over 200 days, which ended in mid-2021. So this is the second longest streak in Zambian history on record of loss of currency. Of constant loss of currency. We have seen is currently closed at about 18.4173, down 0.41%. Now, we are seeing that technically the Kwacha is holding, it isn't a hold pattern in terms of technical trading, but it is showing, and it is, the dollar is in a hold pattern. It is overbought. Effectively, there's too much money actually sitting in dollars currently at the moment. So that is actually showing that there are signs that we are seeing a slowdown in the rapid rise of the dollar. So in other words, the momentum of the dollar is starting to slow down. But in the short run, we are still seeing buying signals that are happening. So there is still some room to run for the dollar, but it does actually show some slowdowns in the buying signals here. And we are seeing that we're getting closer to our 52-week high of the dollar of 18.81 as we're currently closing at 18.41. And it was just a few months ago when we had a dollar that was at 15.41. So that just shows you how much we've seen a deterioration in the Kwacha. When we take a look at the Rand is trading currently at about 1.0896, 0.01% up, showing a little bit of Rand weakness. This is the third consecutive day the Kwacha has lost value against the Rand, and it's also currently in a holding pattern with a few buying signals, but it is starting to cross back into selling signals. It's still showing majority selling signals, and it's somewhere in the middle of the 52-week high and the 52-week low. So we are seeing a lot more momentum on the dollar. Remember, we track the Rand because a lot of our imports are coming from South Africa, but the consistent growth in dollars is also affecting a lot of the electronics imports and non-food based imports that we don't get from the grocery industry in South Africa. Now let's transition quickly to our bond market. Remember that there is a bond auction happening this week, which will close out auction bids on Thursday, which is the 19th of January, 2023. That's going to be the first bond auction with 2.6 billion kwacha of bonds on the auction block. However, we have started to see, we are seeing signs on the secondary market that there is a little bit of bond buying happening. But we did see a treasury auction that was oversubscribed. That was strongly subscribed, especially the 364-day treasury bill. So, and it did see a slight duck down in rates. Now, I don't see this happening on the major parts. And the reason, Vernon, is this. We have seen the adjustment of what we call country risk spreads, country risk premiums. Now, in simplifying terms, a country risk premium simply is what the international investor adds as a markup on interest rates to adjust to basically compensate for the risk they are taking of investing in your country, buying your bonds, buying your equity. So country risk premium especially adds to bonds. What do they expect when they're looking at bonds in the US versus bonds in Zambia? Okay, so that's what they're pretty much looking at. What is the rate of return they're looking at? If I'm a JP Morgan asset manager and I want to invest in government bonds in Zambia, what is the interest rate that will attract me to make me feel comfortable with investing in Zambia? Currently, the January credit country risk premium is currently sitting at 20.71%. 0.71%, which is actually the status for all defaulting nations, be it Ghana, Sri Lanka, all the major defaulting nations. This is captured by NYU Stern, meaning that an investor coming in from the UK or the US is expecting LIBOR plus that. LIBOR is currently at about 5.9%. But if we're going to look even at yields are currently sitting at about 4%. So they're currently expecting anywhere from 24 to 25% yields on bonds for them to be comfortable. And our bonds are currently sitting at about 23%. And they're not really comfortable taking duration risk, meaning that right now that is what is keeping our global investors outside of investing in Zambia. They're not really comfortable investing in Zambia because they're not risk compensated at the moment due to our default status. So firstly, we have to fix our default status, and we're going to have to see interest rates come down in terms of their Federal Reserves and their central banks hiking interest rates. So these are key factors that you're seeing. So that's probably going to affect the bond auction because we're likely not to see any more activity still from the international investors who are waiting for their central banks to start dropping interest rates, and also for our creditor negotiations to finally come to a halt. So the expectation from me coming from this auction is that we're probably going to see the same interest rates. Now, I say this for Zambian investors all the time. You have got staggered inflation that's sitting somewhere at 9%. You've got bonds that are yielding, or at least giving you a return on investment somewhere around 18.6% if you're investing in about 3-year bonds and 5-year bonds. My advice to as many people is always, whenever you see a situation like this where bond yields are elevated and you're getting higher than normal interest rates and you've got an opening, is to snatch up as many as you can so that the returns on investment of your bond portfolio will be held through a period maybe when the offshore investors start to come back and push interest rates down. So that's something we all have to keep into consideration as a country. And those who want to play in that space, those who want to manage their retirement portfolios, those who want to manage their wealth estates, this is the time to try and pile in to that portfolio while you've got the offshore investors away, while you've got NAPSA still trying to figure out what is happening with that withdrawal policy. There is still an opening for higher than expected rates with a lot of uncontested activity. So this is the time. Remember that what you see in the treasury bill market is a sign of banks. Banks are the ones who play treasury bills more than anything. Bonds are offshore investors and pension funds. And the offshore investors and the pension funds, who are your lead investors in the bond market, are currently shying away from the bond market. So that's something to take a look at. But if you're looking at the secondary market, you are seeing that there's about 0.81% year-to-date growth that's happened from that's coming from the secondary market, showing that we're probably going to get to about 1.6% on secondary trading. So secondary trading is still showing that the markets are still slow. International in USD, our GRZ bond index is down by 1%, mainly because of the FX rate movements. And also simultaneously, interest rates are coming down, showing that there is a little bit of buying activity happening on the secondary market, pushing interest rates down from 23%. So that's something that we all have to start to pay attention to on the markets. Now, switching from the bond markets to the big guns, which is our commodity markets. The three key commodities that we pay attention to are copper, gold, and oil. What we're seeing is copper is currently trading at 9,185. Remember, this affects a lot of our job market, affects our FX inflows. Remember, about 75% of Zambian FX inflows comes in from copper, and the price is a big determinant of how well we'll be doing in terms of copper FX inflows. And also government tax revenue comes in from the growth of the industry. But remember, we're having slowdowns in output at the moment, even though there's a lot of investment happening in the country. So 9,185, we've actually seen very high levels of copper prices. It did slump a little bit yesterday. Here's some of the news that's actually driving that. Copper is up 3.67% from last week, up 7.8% on the month, and year to date 9.71%. But taking a look at some of the news that's actually coming in from the copper industry. Here's some of the global news that's come in. UK construction growth is actually slightly higher than expected, but still lower than expected on year-to-year trends. We are seeing that the EU industrial growth came in higher than expected, with 1% month-on-month growth for November, even though the UK industrial production growth is still in the negative, but at least the decline was weaker than expected. So we are seeing signs of industrial recovery. Chinese housing prices continue a 7-month slump with a 1.5% year-on-year decline in the month of December 2022. But they are expectations of supportive policies by the Chinese government trying to relax lending to the property sector. So that should actually drive up Chinese housing prices probably in 2023. That might help. But we're also seeing the Chinese economic data is actually has actually seen trade fall to the sharpest it's fallen since the beginning of the pandemic back in February 2022, mainly driven by slow exports from the shutdowns. Now, there are expectations that you will see imports from the Chinese industry rise, but there is sluggish exports. Remember, China is transitioning more to a service-driven economy than it is to a manufacturing-driven economy due to the expensiveness of its labor. So we might see that the exports towards our Chinese markets might become a problem, but remember that there is an electric car sector that will probably support that. Now, in terms of the supply side of copper, there is some interesting news coming out of Peru. Peru's economy expanded only 1.68% for November year-on-year, which is slower than the previous month of 2.01%. And you just saw that under that now, it is likely that the economy will grow under last year's 2.9%. And this is mainly driven by slowdowns also in output of things such as copper. Thousands of people in Peru have marched on the capital, demanding the current president be stepped down due to the ousting of the previous president, Pedro Castillo, who tried to do a coup as president. I don't know what was going on there. 42 have been killed in these strikes, and the labor minister has stepped down. And you have seen shutdowns in the tourism and the mining sector of Peru. So you can see that supply side. Remember that Peru is the second biggest copper exporter in the world. And if you're seeing the Peru mines slowing down, that means supply is going to have a problem getting on the market. And all these labor issues that are happening in Peru and Chile are going to start reflecting in the supply of copper in a time when the EV sector is rising to actually push copper demand upwards. So we are seeing more of an upside for copper prices. Whether our domestic output is going to meet that, that's a different story, especially given the energy situation where we talked about electricity also being slowed down to the mines. And we've also seen mines continuously throughout last year slow down their output as they've been waiting for stronger prices, especially waiting for a recession to pass so that they can sell copper at higher prices after the bounce back of that recession. Oil prices also, we've actually seen oil prices up to 85.28. Oil prices actually up to a high that we haven't seen since November. Since mid-November. That's when we saw oil prices last at this level. Oil prices are currently at the mid-November high prices, 1.49% up, 7% up on the week. This is one of the highest oil price weekly gains that we have seen. And we said oil posts the strongest gains, mainly due to expectations of softer rate hikes and rising purchases from the Chinese. Remember, the Chinese are having their new year, so they're actually moving around. Restrictions have been removed. Therefore, Chinese demand in the oil sector is actually picking up. Simultaneously, we're also seeing that there is the expectation of a weaker dollar. That will also drive oil demand upwards. Now, this current price of oil right now, with our mid expectations, is showing that we're likely to see a zero movement, even with the new taxes in our oil price. Probably we'll see it stay somewhere around 24. In fact, our index is actually saying we should actually see oil prices rising. So we've actually seen global oil prices are actually putting pressure on domestic pump prices to rise. So we are seeing inflation risks coming into our economy again. Even though we had that push back down, we are seeing that come back up. And finally, the final commodity we're looking at is gold, which is at 1,970. Gold is hovering at highs as we're waiting for growth data. We saw softer inflation data, and we're seeing gold pushing up to 1,980. In dollars, gold is up year to date 5.23%, and in Kwacha, gold is up 7.09%. It's been the best performing asset for us to look at. So that's our roundup of the global markets. We are seeing a lot of data pushing towards an industrial recovery and slowdown. Now, extra data we're seeing on the global economy in terms of our economic calendar data is we did see Japanese PPIs showing a little bit of inflation problems that we're probably going to see in the auto and electronics sector, mainly because Japanese purchasing price index has actually risen to a 42-year high, showing that the Japanese manufacturing sector is experiencing massive inflation, but there is no expectation of tightening, so the yen is still holding strong. But the expectation is that somewhere along the lines, the Japanese government is going to have to step in and fix the situation. Now, from some of the data that we're seeing in the previous day, in other words, Sunday data, Saudi Arabian CPI is at 3.3%. So we are seeing that their inflation is still high, but slowing down. As we talked about, Japanese PPI is at 10.2%, monthly PPI is 0.5%. We're seeing Korean exports sliding down, Korean imports sliding down, and the trade balance of Korea is getting weaker and weaker. And as we talked about, Chinese housing prices are getting weaker as well. Other international data that we're paying attention to is that Chinese growth is expected to be 4.9% for the year 2023. Remember that China and Zambia's economic growth move together, 87% correlation between the two. So when we're seeing Chinese economic growth, which was supposed to be a strong economic growth of 7% throughout this period, but due to COVID lockdowns and due to trying to recover and the transition to a service-driven economy, we are seeing a slowdown of Chinese economic growth, meaning Zambia has to search for economic growth outside of the regular Chinese markets and look to try and trade elsewhere. So that's why diversification of trade is going to be very important, especially outside of that. So these agricultural exports will probably do Zambia a lot better, especially because we're seeing Chinese data coming in weaker. Now, let's take a final look at data that we're expecting to see today. We are expecting to see German WPIs. This is inflation data coming out of Germany. We're expecting a little bit more Chinese growth data, GDP data coming out of China, industrial production data year to date coming out of China, retail sales coming out of China. And we're expecting to see negative data all the way through. Fixed asset investments, that should be fine. GDP data is expected to be 1.8% year on year, quarter on quarter 0.8%. We're expecting also Chinese GDP year to date to also be around about 1.8%. Production, industrial production, we're expecting it to be about 0.2%, with retail sales down 8.6%. That's the expectation of coming out of China. So that's the data there. And our four horsemen indicators are telling us slowing inflation except for Japan. Interest rates expected to continue coming down. Commodity markets starting to rally. So we are seeing some industrial growth, but that's also bringing inflation risk back into Zambia. But we are seeing a little bit of a growth rebound that should start reflecting, though it's still slower than expected. So that's our outlook for everybody to look for there and looking at what's going to be on the markets. Now, let's take a look at some domestic news for everyone here. And this is where I'll just keep looking at things that could be inflationary, growth oriented. I'm looking for inflation and growth based news. Now, this has got to do with what's been happening in terms of our national policy. We did see our president travel to Angola last week, and where they were three main outputs of the deal. One, There were some deal signs. Obviously, there was a lot of trying to reestablish friendliness within the deal. But Zambia has committed officially to investing in the Liboto refinery in Angola, which can produce about 200,000 barrels of oil a day, much higher than Zambia's 40,000 barrels that we need. And we're going to join a consortium of private investors. Now, my view has always been that that Southern African countries should have been putting money together to go and finance refineries in countries like Angola to try and help with energy, with crude oil, to actually work with oil demand. But for some reason, we never seem to work in that line. But Zambia has actually stepped up as a country to go and invest in our fellow African country to try and secure cheaper oil. Now, that refinery is expected to be on the market by 2026. So it's not expected to be now operational until 2026. And that's probably 2026 to 2030. That's probably when you see the impact of Angolan oil coming into Zambia. Now, they're also working on pipelines. Now, there's also work being done that trade deals and memorandums that were signed had to do with transport networks being built, borders being opened, and a potential fiber line that's supposed to come in from Angola into Zambia. And they're also looking at transportation from that Liboto refinery through into Angola and through Congo, which should be the Kolwezi line. So the expectation is that we should see 2026 onwards, probably oil prices start being able to come down structurally, not just market driven. But the problem is by then we'll probably even see oil prices push down because of the EV push as well. So there is peak oil happening right now, and oil prices will probably start to slump down as well. So there should be a strong push down of oil prices somewhere in the next 3 to 4 years. Now, the intermediary strategies that we should be looking at as a nation in order to support that kind of oil deal should be that we're waiting for the diesel line that's supposed to come in from Tanzania, the Tazama restructuring to get finished diesel to come in. And we're supposed to be looking at ethanol blending. This is something that we've been talking about, ethanol blending from cassava with Sunbird Energy, and ethanol blending for companies like Zambia Sugar, who have excess molasses to produce ethanol. That is supposed to be reflecting in our oil prices. And this is stuff that's supposed to have been started in December 2022, but we haven't gotten any news of the commencement of these things from our energy sector. We're probably waiting for our energy minister to start making statements on what's happening on things like that, because that's the interim solution to try and curb the rising oil prices that are coming from the expectation that the Federal Reserve is going to be lowering interest rates. And you are seeing your oil speculators who are trying to play the commodity markets during high inflation times to see if they can get higher oil prices, who are pushing up crude prices. So you are seeing a push up of crude prices happening during that period. Sorry about that. We did get a little bit of a cutoff there. We are seeing that our hopefully that's not me being disrupted. We are seeing that our president did travel to the United Arab Emirates to start working on to go and attend the sustainability conference, and also to work on energy deals. Deals surrounding the energy sector, and there are some outlooks on there. Now, we are seeing a question here by Mlungu Ruben Jerem, who has asked, sorry about that. We did have an interim. Sorry if you could just get back that question. We did see a question saying, what is your prediction on this week? When are we likely to see the curve turning? Interest rate curve will probably turn. So yes, that's now answered. Interest rate curve is probably likely to turn somewhere in the third quarter to fourth quarter, when we start seeing the return of offshore investors. That's what you really have to pay attention to. The return of offshore investors, that is likely to then turn your interest rate curve downwards. So that's just something. If we can just be given a moment. Sorry about that. We're just having a little bit of a technical. about that. We have been having a little bit of a technical moment with sound, but yes, you are likely to see your interest rate curve only start to change when two main factors happen. One, our debt is renegotiated, bringing down our country risk premium. It's the country risk premium that's actually deterring a lot of these people from coming into Zambia and pushing the rate down. So the interest rate curve is only expected to start coming down when the country risk premium of this country also starts coming down. And the second thing that's likely to keep the we're waiting for is sorry, we just seem to be having a little bit of a network warning, but we're also waiting for the reduction of interest rates coming from the rest of the world. So we are waiting for their central banks, which are only likely in the third or the fourth quarter to start reducing interest rates. So our bond curve is only expected to start coming downwards. Our yields are only expected to start coming downwards somewhere in the third quarter, unless there is some magic deal that's going to start pushing a lot of our yields stronger in this period. But I doubt it. Our bond investors they've really ranked us with a 20% country risk premium, and they're waiting to see yields that are worth that country risk premium. So it's that country risk premium that has to come down. And you're also seeing it even in our bond, our auction rate, our euro bond market, our secondary trading of our euro bond market. We're also seeing it from there. Now, finally, in the news outlook for today, because Monday is always that heavy-handed day where we are always looking for information. Monday is always that heavy-handed day. I wanted to just share some things on the electricity sector because we are still having conversations about what are the best policies for us to look at. One, as a nation, we are pursuing a special purpose vehicle. We are getting announcements from the president's advisory team that there is a special purpose vehicle that will allow Zambians to take ownership in a solar project or domestic power plant and power projects in the future. We're likely to wait for the actual details on that, but it's still in the concept phase. For now, that's data that we're still waiting for to see what that'll actually yield, what that will actually look like on the ground. But there is some things that I wanted to quickly share in the energy space in terms of what the best option should be. And I think there's data that we don't talk about. And I've actually been one of the people who has constantly been rounding up about the conversation of the energy, about the conversation of the fact that grid demand has actually been primarily driven by the growth of the domestic sector. And I want to quickly show some data to support that assertion, that it's actually been the growth of the domestic sector that has actually led to the majority of the grid expanding and the grid's growth itself. So here's a quick chart, and I'm just going to share this quickly, that shows you who has been the main contributor of the 25% growth in grid demand. And you'll actually see that throughout this, let me just grab this quickly, you'll actually see that it's been the domestic sector that has been the prime contributor. And as you can see in this chart, as you can see in this chart, 58% of grid demand, and I hope everyone can actually pick this up, 58% of the growth in grid demand between 2014 and 2021 has actually been a result of the domestic sector. In other words, the household sector. And followed by the manufacturing, construction, and quarrying sector. Mainly the quarrying sector has been the key driver to that. And the financial and property sector, with all these malls popping up across the economy. So this is data that was extracted from the annual reports from the Energy Regulation Board, starting from 2014, 2015, all the way up to 2021. So this is actually showing us the data of actually what's been going on. As you can see, agriculture has only contributed 2.5% of grid demand growth. Mining has only contributed 5.8%. In other words, the mining sector has actually been sitting flat with the exact same electricity demand for the last few years, and others, in other words, the remaining sectors have actually contracted in terms of their grid position. So really, it's really the expansion of households that's actually leading to this issue. Let me actually just add in quickly when we look at growth of households. Vernon, it's actually unheard of the fact that we've actually been adding to this grid. To our grid, we've actually been adding about 50,000 households to the grid per year. 50,000 households have been getting connected in terms of electricity. So that's why I keep saying every time you see a couple getting married, every time you see things happening when you see people having parties and weddings happening, just know that that's a new family that is actually going to join the grid and push for demand on the grid itself. So here's the actual data that actually shows that actually you can actually see here quickly is a quick outlook on family size growth. So this has actually been the size of residential clients of the grid. And as you can see, we went from 568,000 residential clients in the year 2013. Now there's a gap in data because the annual reports were not capturing it, but we've gone from 568,000 residential clients to 1.01 million. So we've almost doubled the amount of people who are connected to the grid over the last 7 years. So in other words, grid growth has actually shown the fastest. It's about a 6% growth in houses, and this is reflecting about 50,000 houses, 50,185 houses to be exact, on average per year since 2017, all the way up to 2022, going up to 2023. So the number of houses that are connected to our national grid is actually one of the key drivers. However, it's not really the only saving grace for the domestic sector is the average usage per household. The average usage per household is actually coming down, meaning that what we're seeing on the grid, and let me just grab this data very quickly. What we're seeing on the grid is that the majority of the houses being connected, and again, there's a bit of a gap in the data again, but the majority of the houses being connected into the grid are smaller houses. So it's your smaller units, your flats. It's not your big houses and your big family homes and your farm estates or things like that, or you these big luxury house estates. It's your 3-bedroom flats and your 2-bedroom flats, which are probably going to use a lot less. So you can see average household consumption has gone down from 468 units per household to about 367 units per household, down 21% during the same period. So the only saving grace is that it's smaller houses being added, but the quantum of houses, and I think this is what's been driving ZESCO's decision to add to increase the prices. And finally, just something for us to look at in terms of data, and then I'll give you what this all means, is the average growth per sector in terms of electricity demand growth per year. Now, if you're looking at electricity demand growth, you can see that the fastest growing sector is actually the manufacturing sector. The second fastest growing sector is your financial and property sector. Third is your domestic sector, which is growing at 5.2%. Your slowest growing sectors are actually other, but of these main ones, it's actually mining. Mining is actually only growing at about 0.4% in terms of electricity demand. So there's actually been slow mining growth because of slow mining output. So it's really been the domestic sector, you can see, being the 32%. It's gone from 31% to 35% of grid demand. Now, the reason I'm showing you this data, that the domestic sector is responsible, and I'm going to go back to that first slide I had put out there, that the domestic sector is indeed responsible for 60% of grid demand. In other words, it's the connection of homes. It's the new households that have been coming onto the market. That it is the domestic sector that's responsible for 60% is simply because our markets, our strategy as a country to curtail load shedding and to actually deal with this issue should actually be reflective of how do we try and curb the growth of demand of the domestic sector without straining our sustainable development goal of cheap and affordable clean electricity. Okay, we actually have a United Nations Sustainable Development Goal of trying to make sure that we provide cheap and affordable clean energy to homes. But how do we do that while simultaneously not straining our grid? Because our grid is not going to grow fast enough. Yes, we're trying to organize all these trade deals with Saudi Arabia. We're trying to get energy deals with the UK. We're trying to get billions of investment, but it takes 5 to 8 years to get a power station online, while we're adding 50,000 houses to the grid every single year. And we're seeing a 5% growth in domestic sector demand. And we're trying to ramp up our mining sector at the same time. This is why I've been talking about solar transitions and gas transitions of households, to make sure that they have clean and affordable energy, while making sure that we can get while making sure that we're not hampering economic growth and the growth of the economy. Economic growth and the comfort and the rights of our people. Because electricity in some countries is actually pushing to become a civil right. It's actually looking to be a civil right. And there was a landmark case in India that actually pushed electricity to be a civil right, because it's required in the right for a person to work, a right for a person to have a healthy housing situation, such as lighting, a right for a person to have food and energy. In other words, to be able to cook, because it's actually becoming a baseline of things like that. Energy, household energy, is actually being considered a civil right in many countries, and that whole movement is starting to grow. So we should be looking at how to infuse the solar sector into households. How do we give cheap loans and good incentives for people to be able to transition to home solar solutions, gas solutions, so that we can have gas and solar to be able to take as many of these houses off the grid? So you need to counter the 51,000, the 50 to the 51,000 households that are entering the grid every year. Plus, you need to take an extra 20 to 30,000, or you need to target the large consumption homes and start taking them off the grid. Those that consume about 1,000 units of power plus, because the average one is consuming about 367 units of power. The ones that are taking 1,000, you get them off the grid as quickly as possible. So that's some data just to look at how to actually manage this situation and what we should be looking for as a country. This is why I've spoken about things like giving out gas stoves. This is why I've spoken about things like solar transition loan support, loan guarantees. This is why I keep pushing at this whole movement, because there is a much sharper thing that we should be looking at how to allow the domestic sector to still grow without straining the grid, because it has been the biggest contributor to grid strain during this period. Now, quickly, just to close down today's conversation, I wanted to talk about push and pull forces in a person's finances. And I quickly just want to give everybody one simple activity to do in these last 2 minutes, as we're doing our financial momentum building. And financial momentum building, I am talking about how to actually position yourself for financial momentum, how to build your financial momentum. And the two things I want you to focus on is learning how to use push and pull to build momentum. What are the things that will push you to make good financial decisions? And I'll tell you, the biggest things that push you in life are the things you are afraid of the most. Okay? Your biggest fears are the things that will push you. What are your financial fears? There are there are three main financial fears, but there are really four that you're looking at altogether. One is the fear of personal poverty. Okay? That fear that you will slip into personal poverty is one of the biggest things that pushes people to actually start making good financial and investment decisions. So you've got to document and always remember the fear of poverty, your inability to meet your basic needs. That is something that you should always be afraid of, that should drive you to make good financial decisions. Two is the fear, and I want to see people actually take these down in notes. Two, the second fear you're looking at is the fear of inadequacy, your inability to provide for your loved ones. So poverty, inadequacy, and the third one is the fear that your ability to provide for yourself and your ability to provide for your loved ones will be taken away. So you're looking to protect your situation. That's one of the things that you're looking at. And simultaneously, the fourth fear you're looking at is that the time in your life will run out. There is a point where you will pass away. There is a point where your life will finish. And you want to make sure that you've done as much with your life that is as good. So the running out of time is also another thing you really want to focus on, because you want to maximize and utilize your time for the things that will pull you to better financial decisions, And the three things that will pull you to better financial decisions are what we call life's fulfillment. And the things you want to push your life that will pull you in terms of your fulfillment are things that I say are your legend, your legacy, and your lineage. The legendary life you want to live, the legacy you want to leave behind, and the people, the lineage you want to leave behind to continue your work and continue your name. These are some key things you want to do, because these are the things that will lead you to have momentum in your decision making and to continue pushing yourself to do better. So please remember, there are 4 fears. Fear number 1, fear of poverty. Number 2, inadequacy. Number 3, peace and protection. Number 4 is what's it? Time is running out and you're getting older and you're running out of time. And the desires that you want to push are your legend, your lineage, your legend, your legacy, and your lineage. Put those things together and you'll be able to now strike your financial plan in a way that is more emotionally appealing and will be able to override the waste and the worry that usually stop you from being able to make good financial decisions. With that, Vernon, we end the Monday edition of Behind the Markets. I don't know if you're still with us right now, Vernon, but we are closing down the Monday edition of Behind the Markets.
Thank you, indeed.
Moving into the final section.
I appreciate it. Thank you so much. We'll see you around.
Thank you very much. Have a good day.